And for more insight on today's global market sell-off, we're joined by Dan McClory. He's the Managing Director and Head of China and Head of West Coast Investment Banking at Burnham Securities. Dan, good to see you.
Hey, good to see you, Michelle.
Dan, wish it was under better circumstances. We have carnage across the board, carnage on Wall Street, all three indices down over 3.5%, almost 4%. European markets got hammered down between 4 and 5%. And of course, the Shanghai Composite down over 8.5%. Dan, what is behind this global market meltdown? Is this a case of China sneezes and the world catches a cold?
You know, it would certainly be easy to jump to that conclusion. And I'm reminded, here in Beijing this week, we've got quite an event going on, the World Athletics Championships. And I was in the stadium the other evening before Usain Bolt defended his 100-meter title. And the fans engaged in a wave, which, of course, is that gesture where you go around the stadium and this wave continues and it builds momentum. So we've had this wave that started in Asia, not just China, but started in Asia. It's moved west to Europe and eventually into the United States. Again, I think it would be very easy to jump to the conclusion of what's occurred in the last two trading sessions in New York has to do with China, but I'm going to take a different tack. I think investors have not been wondering if there's going to be a correction. They've been looking for a justification to have one. Because remember, corrections also result in buying opportunities. In the U.S., we'll have maybe 3 or 4 pullbacks per year, certainly not of the level that we've seen in the last couple trading sessions. But corrections are not always bad, and I think it's a rush to judgment to say this has all been brought on by China.
Well, corrections are not bad, but China does seem to have been the spark for the sell-off, although China's stock market is not as big a part of the Chinese economy as stock markets are for other economies. The U.S. stock market, for example, plays a much bigger part in the U.S. economy than the Chinese stock market does in the Chinese economy. And Dan, we know China's economy is transitioning. We expect growth to slow at 7% GDP growth. It would still be double, even triple that of developed economies. This is an adjustment. We've been told this is coming. Do you think that this has been an overreaction?
Not necessarily an overreaction, but remember, China is engaging simultaneously in 3 incredibly substantial tasks. So the liberalization of the financial system, the rebalancing of the economy, and sustaining a rate of growth, as you point out, that is the envy of the developed world. I think when we compare the sell-off, when we compare the correction, we look at New York in the last 2 trading sessions, $800 billion in equity values wiped off of stocks, over $3 trillion from Chinese equities since the correction started in June. So yes, the figures have been substantial, but obviously China has taken somewhat of a beating in this whole market. And we're really seeing what I would call the largest investor education program in the world, certainly in the developed world, where the trading patterns, the investment habits of Chinese investors are going to be shaped by what's going on in the past several months.
Well, they're definitely learning the hard way. You know, Dan, there's been a lot of criticism against some of the actions that Chinese regulators and the People's Bank of China have taken to try and stop the market sell-off, saying that in a way this interference sent out panic signals and caused even more losses, given that the market is mostly retail investors-led and it follows a herd mentality. So the question is now, do you expect the People's Bank of China to take some action? Should it take some action? It almost feels like Wall Street and European markets are sitting on the sidelines waiting for the PBOC to do something.
Well, you've pointed out a very interesting trend, Michelle, and that is initially it was retail investors' reaction to market intervention by Chinese regulators that was seen as a way to stabilize. Well, now the global economy has watched and has expectations of China in that same regard. I don't think further intervention is required. In fact, I think China has been almost trying too hard to prop up perhaps and to support certain levels of the stock market. I think the Chinese stock market and Chinese investors need to understand volatility is a way of life. This is something that comes with the territory, so to speak. And again, one example that I'll make of comparing the 2 markets is when Shanghai started shooting through the roof almost a year ago, the S&P was virtually unnoticed in terms of that development. So why today is the S&P being unfavorably impacted as a result? There's kind of a double standard that's going on.
There is a double standard. You're absolutely right. Shanghai was soaring and U.S. markets made very little of it. But now they do seem to be focusing on China and there is an expectation for the PBOC to do something. Do you think it should and will make a move?
I don't think they will make a further move, and I don't necessarily think they should. I think the mini devaluation of the yuan last week was misinterpreted, and so I think the government is going to be very cautious about what it decides to do next.
Well, what impact does it have back here on the Fed?
Clearly, with the correction of the last couple of days, if there was a window for the Fed adjusting rates, it's quickly gone away. I don't think we're going to see any change in rates in the Fed anytime soon.
Dan, you said that investors are really wanting an excuse for a correction. So does this mean this is a good buying opportunity?
In the U.S., we absolutely think it is. We think that Chinese retail investors need to be further educated about underlying equity values and really what the determinants of those values are. So there's a further evolution that still needs to occur in China. But in the U.S., remember, when the share price of good companies go down, that doesn't mean they're any less valuable. That just means they are caught up in a market trend that would characterize them as being less valuable. Those still represent good buying, and we think those opportunities are going to continue at least for the next several sessions.
All right. Well, let's see how that plays out. Thanks so much, Dan McClory, Managing Director and Head of China and Head of West Coast Investment Banking at Burnham Securities.